Hey everybody, it's Mike from Orderflows, and welcome to today's video. Today I'll be talking about the aggressive traders in the market. And today was election day in the U.S., and we had this nice big run up from just after the cash open, we dropped down about 15, 20 points almost, and then we had this huge rally all the way up to 65, and it sort of went sideways, and then it really just fell off the cliff after 12, and then it rallied right back up towards, didn't get up towards a high, but it got back up towards the 55, before closing the day at, what was that, around 38, 33 or so. I forgot the exact number. But, I want to talk about the aggressive trading that was taking place in the market and, how you can use that to your advantage. Now, people like to say, well, the market was up because there was more buyers than sellers, or the market was down because there's more sellers than buyers. Well, that's not really, an accurate portrayal of the market. For every buyer, there is a seller, but what causes the markets to go up and go down are the aggressive traders. Okay, now you have basically two types of traders. You have aggressive traders and you have passive traders. Think of it like this, okay? Markets trade in a two-way auction. There's a bid and there's an offer. People that are working a bid or working an offer, those are the passive traders. The sellers that cross the bid-offer line and hit the bid, sell into the bid, or lift the offer, buy the offer, those are the aggressive traders. And, don't get too confused by that. It sounds more complex than it really is, but think of it like this, right? We've all bought a house, or we've all thought about buying a house, and that you look online at wherever realtor.com, you see a nice house that you like. It's $500,000, but you don't want to pay $500,000. You want to pay $400,000. So there's a seller. He's a passive seller at $400,000. Sorry, at $500,000 at $500,000. He's the passive seller. If you pay his asking price, you are the aggressive buyer because you want to get that house. You want to get a home. Now, if you think, I like this house, but I only want to pay $400,000, you submit a bid, $400,000 for the house. If the seller's like, you know what, interest rates are going up, less people are buying houses, I just want to get this off, get this house sold. And he goes down and hits your bid. He's like, sold, sell it to you for $400,000. That seller, he crossed the bid offer line. It was $400,000 at $500,000. So he crossed that. He was the aggressive seller. Okay, so that's it in a basic sense, right? So we're all seeing aggression every day, in everyday markets. Okay, buying a car, you go to a dealer, there's a sticker price. You guys negotiate back and forth. That's the two-way auction. So aggressive trading is what causes imbalances in the order flow. Now, this could mean different things. Okay, one, it could just simply mean a large order is making its way through the market, which causes an imbalance. Okay, so for example, you see this here, like this bar right in the middle, 105, 22, 86. Maybe someone just had a large order, they're coming through the market, and they're just slowly lifting the offers. Okay, that is what happens all day long in the markets. People with big orders are working their orders into the market, try not to move it too much. Now, where it gets interesting is sort of the passive buyers causing absorption in the markets. Okay, now, for example, you see this green candle, right? But it's got a selling imbalance, 122 against 23. And, it's a selling imbalance, so you think there's aggressive sellers in the market. There's aggressive sellers are in control. Yeah, it's causing a selling imbalance. Why isn't this market moving down? Well, it's met with some passive buying, right? Some strong bidding to absorb whatever aggressive selling is taking place in the market, right? You see another one up here, the 251. Here you see 108. Here you see 76. These are all green candles, right? And it's like, generally markets go up. You're looking for the buying imbalances, right? In the green candles, that's what you expect to see on a market going up. On markets going down, the red candles, you expect to see selling imbalances, right? And you see here 85, here's a 41, here's a 143. So where it gets interesting is obviously when you got those green candles, right? The green candles with the selling imbalances, or the red candles with the buying imbalances. So oftentimes when you see the red candles with buying imbalances, it's people coming in with supply in the market, right? As the market is dropping down, people that have supply want to get rid of it because they want to sell it now rather than at lower prices. But when a market is rallying, it's starting to go up, and you start seeing selling imbalances in the green candles, that's a sign of absorption. So, you got to not just take it on its face value that, oh my gosh, there's selling imbalances, I got to get short, right? Because it could be a sign of absorption. And today, when we were rallying, there was some really big size coming in, right? This was at 1024. Big size in the market. I mean, look at this, 1151 against 262. This bar right here, as we're breaking out to these new highs at 55, big buyer, another big buyer. It's probably the same buyer. Someone just bidding it up. And when you see that in the market, pay attention to it, because it's often, a sign of, obviously someone is supporting the market. And if the market is going up and you see support coming into a market, chances are the market can go higher. I mean, we did go higher. We shot up to 67. That's a quick 12-point move. It did pull back a little bit, but then you start seeing the aggressive buying coming in again. Buying imbalance, buying imbalance, buying imbalance, more buying imbalances, on the way up. So again, don't take it on its face value thinking, oh, because I got this big selling imbalance, 1151, the market should be going down. Well, it's not, right? We're trading above that. It's a sign of absorption. I don't want to call it trap traders per se. That's a phrase that gets used very loosely by traders trying to describe something that, in my opinion, isn't really a fair representation of the market. But when you're dealing with imbalances, depending on where the imbalances appear in a bar, it can be significant. Okay, and we do have tools like in our Orderflows trader software to identify, trap traders in the order flow. Okay, so, for example, we have what's called an imbalance reversal. Okay, and I'll just pull it up here, right? This is, my regular footprint chart. I'll just go back to my chart that I was, I like to use this one for the YouTube videos because it's just a plain footprint chart, because I like to shoot the videos for people that, have other software and can learn something. But an imbalance reversal, I'll just draw it here. Light green. I'll just make it a little darker so it's a little easier to see in the video. It's basically a sign, is using imbalances, right? The selling imbalances in green up candles or buying imbalances in red down candles as a sign of potentially trapped traders, right? Because it's not what you're expecting to see, and what it is, it's a sign of supply coming into the market. As in the red candles, as the price is trading lower, you have someone coming in and offering it, or bidding it, on green candles, green up candles. So let's see here. Here's a perfect example, one right here. Right, 160, right? You see how the market sold right down off of that, right? Market is selling off, and as it's selling off, people with supply are coming in saying, hey, you know what? Let's, I'd rather sell it as much as I can up here. I don't want to necessarily push the market, so I'll just work the offers, right? They're passive sellers, but they're absorbing whatever aggressive buying is taking place. It's 25 against 160, and you see the market, sold off, came right back up to that area where you had that supply coming in earlier. There was a level up here. Now these are being drawn until tested. So if it comes back, in any bar, it's going to stop drawing it, just as, over here was the level and it stopped. I mean, you could draw it out until tested, or you can draw it out, a fixed level. But it came back right to that level, right? Traded 5 lots, another 5 lots, and then it dropped down. Now here's a bullish one. Okay, now it came in. Market started to rally, then just went sideways before falling. This was that big sell-off. But you can see here we got this green from much earlier. Before I started talking, here was a bullish one here. But this was that earlier here about 9:30, right? This is an imbalance reversal. Right? This is support coming into the market. as this market is moving up. And look at that. This is coming in around at what, 932. When we're trading around 38, 38, and we rallied all the way up to 10 points. Okay, and this level held for quite some time. It did eventually come back there, in the afternoon here, 12. I don't know if there's any more. Here's a small bullish one here at 1 o'clock. Here's a small bearish one, just sort of went down. Then you got this nice one here at 38.21. So you could have been selling it, after this bar closes, 38.18, and all the way down to below 3,800, down into these new lows here, right, where you had a bullish one, but it just came right back into it. So that's how you can identify signs of absorption. Again, I wouldn't, people will call it trap traders, and I hate to use that term, because you see these volumes, it's 9 against 58 lots trapped. That's not really trapped. If it was 580, yeah, I'd consider that trapped. But it's really, it's what we call an imbalance reversal. It's people that have supply to absorb whatever aggressive buying is taking place, right? And it's a great way to identify trade opportunities in the market. So hopefully you're coming away and understanding that imbalances have sort of dual meanings, right? They are a sign of aggressive trading, but it can also be a sign of absorption or distribution taking place in the market. Okay, so I hope you guys enjoyed this video. Over the weekend I released a course, situational order flow trading course, and it's been getting, people have been writing back towards me, telling me, hey, that's actually a nice course. They're learning a few things, like a few new order flow based setups that they could use. And again, if you're interested in it, if you haven't seen, I'll put the link in the chat, or not the chat, in the description below. But this is what it is. You just go to orderflows.com / / situational. And this is the page. This is everything that you'll learn in here. Things like combining price action with the order flow, signs the market is about to shift based on the order flow, some order flow price patterns that's going to help you predict the next big moves. When order flow is sending mixed messages, if you can detect market manipulation in the footprint, it's difficult. I see a lot of people complaining about manipulation in the market, but really, you can't trade in fear that there's manipulation out there. Even though there is, CFTC still catches people for doing, things like spoofing. Even though everybody knows spoofing is not legal, people think they're going to beat the system for some reason. Then they end up getting caught. Structural and active order flow, what the differences are, how to use it. Then I discuss, a bunch of price pattern setups, with the order flow. Of course, we'll talk about risk, and then we wrap everything up. And right now it's on a special. It's only $99 off its $297. This is a new course. It's different than all the other courses I've released. So again, if you're interested in it, the link is below. And again, thanks for watching this video. Be sure to subscribe to the channel if you haven't. I'm trying to get some more videos up. I sort of went on a hiatus for a little while. I just had a lot of stuff to catch up on. Halloween is always a big holiday at my house, and it took a while for me to recover. So thanks everyone. Have a great day. Bye bye.